Hi, welcome to Elevate Market Chat. This episode was recorded April 17th of 2025. This year has started off with some volatility. The S&P 500 was recently down almost 20% before having the third largest green day in recent history. Shane and I will review this, sector performance, and briefly visit economic front. Thanks for tuning in, and if you like what you're hearing, please help us spread the word by sharing this episode with friends. Shane, how's it going?
I'm busy. I've been busy, and looks like I'm staying busy. The old Donald Trump is keeping everybody on their toes, especially people who want to call themselves portfolio managers for a living. So it's not a time to do nothing. We're not, as I wrote in my last abbreviated commentary, it's not like I'm worried or panicking or anything like that, but there's much to do in these volatile periods. So whether we're hitting some stops on things that we've owned before, or getting buy alerts on things we've been waiting to buy until they dip into buy range, or certain clients that want to make changes to their portfolio allocations because they were very aggressive and had a very high risk tolerance when the stock market was consistently just going up. But suddenly, when you get a drop, it's amazing how people's risk tolerance can dramatically shift. So, a long answer to your opening question, but I would encourage listeners to this podcast to always answer those questionnaires honestly, regardless of how the market is currently doing. Maybe even consider, how might I answer this question if the market had just dropped 50% instead of just risen 50%? And if the answer would be different, then you should think about it a little bit harder. So anyway, yeah, there's been a lot to do recently. How about you? How you doing?
I'm doing good. You mentioned what's going on and headlines. I can't even keep up with them. That's kind of like watching two kids fight on the playground. It's like I know you are, but what am I or whatever, and it's just tit for tat. And I couldn't even try to sum it up. I think what blows me away is I've been watching, just the S&P 500 on an hourly chart, and it looks like these little moves, and you look and it's 1% moves. And
Yeah.
that's just unreal. So it's a very volatile time. I think if we zoom out, which is important, the S&P as of market open year to date was down about 11%. NASDAQ's about 15.5% down. The Dow's doing pretty good. It's only down just shy of 7%.
Does that
But
include today's walloping from UNH down 22%, the most since like 1990 or something?
so I have not included it. So that was right at the open. I assume United Health Group was not included there, but um,
Yeah.
that's something we could probably talk a little more about there. But that was again a Trump policy aimed at with them reimbursements, and they're in the insurance industry, and yeah, down 20%. That'd be a hard one to stomach if you had a concentrated position there.
You're just you're in a safe and stable healthcare stock. What could possibly go wrong? Yeah, down. It's not 20 either. It's down 22.65%, and it's a major component of the Dow. I heard on the old Bloomberg Squawk this morning that if things were to close where they are and the Dow finished where it is today and the S&P finished where it was, it would have been the first day since 1954 where the Dow underperformed the S&P 500 by more than a full percent in a day. So lots of things happening that haven't happened in a very long time, or things that haven't happened ever. And as they say, all time is a long time. So yeah, man, it's there's been much to do, lots of activity, and I'm super pleased. I was talking to you guys on our team meeting. We have a weekly team meeting yesterday, and we do that on Wednesdays, and I was just talking about how happy I am with our positioning and where we are and how much cash we have in a position to buy great businesses at fair prices. And how we've weathered the storm so far by following our rules and setting this, following the stops that we put in place before there was any emotion, right? We do that when we enter a position. We never buy anything without knowing how we're going to get out of it. And make no mistake, our favorite holding period is forever. So we want to hold these things for as long as we possibly can. But even the best businesses go through periods where I I don't want to own them. I don't want to defend them to people for an 80% drawdown. I just don't see the need. I personally, again, even if it's a taxable account, I'd rather pay some taxes and buy the thing back later when the storm has passed. So whether that's, Meta dropping 80% in 2022, or Nvidia dropping 80% in 2022, or any other number. I mean, Microsoft, right, took 13 years to get back to break even after the dot-com bubble. So these are the best companies in the world, and anything can happen. So as much as I say I want to hold this or that forever, um, there always comes a time where things you want to hold forever maybe aren't the best place to have a lot of capital parked.
Hmm.
So anyway, we're doing what we tell people we would do, and our clients at least the ones I've spoken to and what I've heard from you guys is, that people are very happy. And gosh, we even have one strategy that's still up, like up for the year, not like up, 10 basis points either. It's done it's done really well, and I am just super pleased.
And what's the cornerstone there? I think it has something to do with a shiny rock.
Well, yeah, I don't know if is it considered a rock? I think it's metal. I don't know. Gold, the precious metal gold. Yeah, that. There's definitely a lot to say about that, and we've taken a fair amount of heat from people over the years for having 4 or 5% of our money in gold, which we hold as we call it a chaos hedge. And it's times like these where you look at gold up 20 some% for the year. How much is it up for the year? Do you have a
So,
number?
yep, I pulled that number at the open and it was just shy of 23% year to date.
Crazy, man.
So,
That's
yeah,
crazy.
it can move. And, you know, just looking back at, excuse me, some of the moves that we've had, the big one that I think caught a lot of people maybe off guard or was just a headline for sure is that on April 9th in one day, the S&P was up 9.5%. And for context, in history, the only two times it's done more than that in a day was, 11.6%. That was October 13th of '08, and then 10.8%. That was October of 28th of 2008. So I don't know what that means going forward, but yeah, you're talking chaos in a chaos hedge. That sure looks like it to me. You get moves like that, that's something.
That's a great stat. I can't, I saw those numbers and those dates as well recently. And before we move on, I just think it's super important to point out the importance of like the timing of those best 2 days in the S&P 500. I think ever, but maybe that data was going back to like 1950 or something, so it may leave out the Great Depression. And I also don't know exactly the date that the S&P 500 started to be a thing, but it's not as old as, as the United States of America stock market. So anyway, point is it's been a really long time. Those are the best 3 days. And the number one day, the best day, and the second best day both happened in the same month of the same year. That was October of 2008. And I always remember this date because it's just like, I don't know, it's counting by threes basically. So it's just easy for me to remember. And I also remember the value because it's the mark of the beast. But do you remember the date that the S&P 500 bottomed during the great financial crisis of 2008, 2009?
That I do not recall.
It's March 6th, 09. So 369. You can That's it. And it bottomed at 666. Very easy one to remember, for better or worse. So but but anyway, going back to those best 2 days were October of 2008. The market did not bottom until March of 2009. So you have 5 months between those best 2 days ever when everybody thought, oh, this is the bottom. We missed it. You better get in, better cover your shorts, better buy the stocks that you want to buy, or you're going to miss it. Well, the S&P 500 dropped another 20 some percent from there. I think it was like 28% more downside over a 5 month period before it actually found its bottom in March of '09. So, um, everybody who, if you're listening to this and you're like, oh, I missed it, that was the bottom, I better get all my money back in. Um, don't be surprised if that's not true. And just like, Kyle, we did talk about this yesterday on the team meeting. A year from now, will the market most likely be higher? Yeah, I think that's probably true. So if you're saying, hey, I'm gonna, we market dropped 20 some percent, I'm gonna I'm gonna go ahead and move some cash from treasuries that I've been holding for a while and just buy stocks, and I'm just not gonna look at it for a year. I chances are, right? Probabilities say that you'll be up a year from today or yesterday or last week. Uh, but if you look in 2 months or 3 months, don't be surprised if you're down another 20 or 30% first. It's not like if you put your money into the market, the past week or so, that was a dumb idea. That's not what I'm saying at all. But I just we don't call bottoms, right? To me, it does not feel like the market has bottomed, and I think you might have a different opinion on this, which is fine. We don't share brains that elevate. Everybody thinks for themselves, and that's why we do a good job. Is because we have a lot of smart people that work with us, and we pay attention when they have a thought or an idea about something. So anyway, we don't share a brain, but I think there's lower to go. I think easily there's lower to go, and anybody who thinks that they have any clue where a certain tariff will be on a certain country a week from now or 10 minutes from now or 30 days from now is either lying or idiotic because nobody knows. I don't even think Donald Trump knows. So
Hmm.
um, we'll see.
Yeah, and I think I like that you bring up the differing viewpoint that I might have, and I think it's good to provide context. So when I'm looking at the market right now, and I'm talking about the S&P 500, and like you're saying, a year from now, might we be higher? I'm looking at today's activity and I go, okay, what's the risk reward and what's the probability? The risk reward here is that I see, like on the SPY, we came down and we hit that major low, bounced up, and that is at a level of what they call confluence. So I had the 200 period moving average based on a weekly chart was hitting there. I had the 2021 high that was also there. So there's a few things that come together. And in my mind, I say, what is the probability that level holds? And it's a good risk level to be in on. If it falls through, maybe you de-risk. But this could be one volatile year, but that is a relative level where the probability seems fairly favorable. And from a risk reward standpoint, you did pull back almost 20%. So it's a nice spot where risk can be tight. You might have some upside, but I think that we're in for a choppy year. Maybe it goes lower from here, but I think it's going to be one where you just tune the news down, don't really listen, and just remember if you have a long-term time horizon and you can go off appropriate risk levels, that can work out well. But we break through there and it could go lower. I think one thing to point out is, well, where would that level be? I think if you're looking at SPY, which most retail investors might look at that to see, what the S&P is or how to invest. I think 480, which is another 20% lower, would be the next major level of support. So certainly there is risk out there, but I think I can't predict anything. But what I can predict, I guess, is it's probably going to be a little bit volatile for a while.
Yeah, and that's why we just prepare for a wide range of outcomes. I do that on the golf course too. I might shoot 100 and I might shoot 75. You just never know. So there's a wide range of outcomes that are definitely possible. I think we're prepared for all of them. I'm certainly prepared for the market to go a lot lower, but I'm also prepared for it to turn around and bounce. I wrote about that in the recent commentary, and I know you're looking mostly at, lines on charts, whether it's Fibonacci levels or support levels from previous pricing, going back a year or something like that. And that's creating those confluence zones that you're talking about, where multiple different technical indicators are all saying this is probably a support level. Um, and I do that too, right? We use both technical and fundamental analysis when doing portfolio management work at Elevate. But as I did write in my commentary, the fundamental basis says that we're not fairly valued for a good bit lower, right? I can't remember exactly where I said the S&P 500 had to get to. I think it was like 4,300 and 3,700, depending on whether you wanted to value it based on earnings or sales. And since then, analyst estimates for earnings have just gotten smoked. Like they're declining every day. So as those earnings fall, the fair value based on historical averages and things like that goes lower on a fundamental basis. So I think we always look for technicals, right? And we'll keep those in mind, and maybe even trade off of them. But if they don't hold, um, ultimately the fundamental levels can come back into play, at any time. So it's always best when the technical indicators and the fundamental indicators align. That's where I feel the most optimistic about being aggressively bullish, or I guess bearish at the same time. But when fundamentals and technicals are both telling me the same thing, that's when I aggressively make moves either to cash or to being more invested, depending on what the environment is. So we do not have that right now, other than the fact that I would say technicals, other than just levels like you're talking about, like right now, the market is in a series of lower highs, right? So the market is trending lower. The 200-day moving average on the S&P 500 is declining. The 50-day moving average has crossed the 200 from above. So we call that a death cross. That happened on Monday of this week. So, you've got both intermediate term, you got short term, intermediate term, and long term trend lines all falling. You don't get a rising, you know, a rising moving average unless you like go out to the weekly, which I'm sure I haven't looked at that today, but I'm sure the weekly 200 week or whatever is probably still rising, but that's a ultra long term indicator. And when they break hard. So as it stands right now, I think I could just see us going lower. It doesn't mean we have to put in a new low. It doesn't mean we have to drop all the way to, a 50% pullback from the highs or anything like that. I don't think it's any reason to go hit the panic button. But I just won't be surprised if we haven't seen the lows yet for this move.
Yeah. And I think something that backs up your point is, I always look at the sector performance. So if we look at that and see how, what percentage of large cap stocks are above the key averages, I've got a little grid here and every one of them is in the red. And what that means is that less than 50% of all stocks are above the 200-day moving average. The only bright spot I'm seeing is utilities. And then just on the short term, looks like energy and real estate caught a little
Yeah.
bounce. But yeah, you're just not really seeing that positive trend that makes you feel good. And that's the big one. Looking for a positive return or momentum to carry you through this year. That's, I think, an unlikely scenario, and one that right now is kind of playing out where it's the trend is down. So we'll see. Maybe it sets a bottom, chops around for a while, but I just don't think it's going to be something where at the end of the year you're like, oh, I made another 10 or 20%.
Yeah, no, and there's just too much uncertainty right now.
Mm-hmm.
And that's, I don't know how the saying goes, like you can, it takes years to build trust. You can lose it all in a moment, you know, or something along those lines. But it takes a long time to build trust. It doesn't take very long at all to blow it up. And yeah, you know, I don't like to talk politics. Certainly we're not, we're not investing on the basis of politics. It's irrelevant. But what I see as far as the damage done in global free trade, and free trade is arguable, right? Everybody had tariffs on us and we didn't have them on them. So is that really free trade? I get that. That's not lost on me. But just to use the lingo, right? The terminology. Our trading partners are probably not just overnight going to be like, oh, okay, never mind. He was joking. I don't see it all kind of turning right back on as quickly as it went away. I think it'll take time to rebuild trust, and I think it'll, certainly take time for people to get used to whatever the new tariff regime turns out to be, or whatever the trade deals turn out to be. I'm optimistic that we'll be in a better place for the long run, and maybe even tackle some of this deficit spending. Although I tend not to believe anything that comes out of Washington, whether it's Joe Biden or Donald Trump or anybody else. They always say one thing and then a totally different consequential thing will happen. And that's the same for Jerome Powell, the chair of the Federal Reserve. He keeps saying he's not going to cut interest rates, but I'm telling you what, if it gets bad enough, he will, regardless of what inflation's doing. Inflation could be 9%, and he'll be cutting interest rates if the economy is bad enough and people and the unemployment rate goes high enough. They won't care. They'll cut rates. So time will
And,
tell how that'll shake out.
and I know yesterday Jerome Powell had a conference and he was talking about some of these things, trade wars and the path of interest rates. Were there any key takeaways that you saw there, or just change in, how he's been speaking about the plan forward?
But my key takeaway is that he's full of crap. I mean, that was my key takeaway. If you just want the Bloomberg version of the notes, it was that he dug his heels in and said don't count on a rate cut. We have the ability to be patient and wait and see what happens. We're uncertain about this and that. We don't know what's going to happen. Nobody knows what's going to happen. It was a lot of that kind of stuff. But one of the things that he said that just totally blew my mind, and I shared with you guys in our Slack chat, with a Pinocchio face in front of it. He said, Powell said, federal debt is not at an unsustainable level. He said that. Um, and somebody corrected me. That was just a copy and paste of the Bloomberg headline. I don't really do headlines that much. I try to look at the numbers when I come into the office in the morning. Like I look at what the numbers are doing, because numbers don't lie to me. Um, News organizations, politicians, headlines, they're all lies for the most part. So I try not to read headlines, but sometimes it's hard when you're sitting in front of a Bloomberg terminal and they're just ripping across the screen. And certainly things like that will catch your eye, where it's just like, what? He said what? And somebody corrected me and said, I guess he said they're not growing at an unsustainable level, not that they're not at an unsustainable level. But either way, those two comments are, I mean, again, he's either lying or stupid. And I don't think he's stupid. I just think he's lying. I think that's posturing, and I think it's total nonsense to think that $36 trillion in debt and over $1 trillion a year in interest expense, to say that that's not unsustainable, or implying that it is sustainable to just continue doing that, you know, in perpetuity. I don't know how you can get there with a straight face. Like I maybe I'm an idiot and I just don't understand it, but I don't think that's sustainable.
Hmm. Yeah, it is.
I mean,
It's
try
a
and run
lot
your
of debt.
household that way. What would happen if you ran your household that way? You would lose your home. You'd start losing stuff eventually, and it would be too great of a cost.
Hmm.
So what makes us think we can run a country that way? Like, what makes us think our creditors will continue to just buy all the debt we want to sell them at interest rates that are, affordable? It seems so presumptive to me to say something so stupid. Um,
Yeah.
I don't know, whatever. Moving on.
Yeah. And the next thing, I'm looking at, Shane, we've talked about this in the past. It's kind of been a bit of a break, but just the steepening of the curve. So what that is that you get paid more to let somebody borrow your money for a few months than you would for 10 years. That finally corrected itself, which usually is in front of a recession. The numbers, I guess, are still saying we have not seen that. Um, Anything you're seeing there?
No, I mean, I just, just normal behavior, in my opinion. I don't know what that'll cause the Fed to do. I mean, we should have refinanced a lot of that debt, for 10 or 20 years when rates were low at the 10 or 20-year points in the curve. But now they're not, and so we have, I think, $12 trillion or something out of the 36 trillion in debt that needs to be refinanced over the next couple of years. And as long as rates are high at the long end and rates are lower at the short end, I would expect them to just keep pushing it out a year or two at a time. So this whole debt waterfall situation is just going to get bigger and bigger until we can find a way to push it out a little bit. Because there's zero hope of ever paying it off. So that ain't happening.
Hmm.
And a steep curve, I mean, is good, for banks, basically. A recession is bad for banks, so it's kind of like, the six and one half dozen in the other. So I'm not sure that means, oh, cool, I want to go buy banks. Um, but banks do make money by, borrowing money from you, listener. The bank is borrowing the money that you think is in your checking account. They're borrowing it from you, and they're paying you a very low rate of interest to borrow that money that you think's in your checking account. And they take that money in your checking account and give it to people for 30 years to buy houses, or 5 years to buy cars, or whatever else they want to lend it for. And so the bank makes the spread, between what they're charging the person for the mortgage or the vehicle and what they have to pay you, in your checking account. So if they're charging, say, 7% for a mortgage, and they're only paying you 0.50 on your checking account, which would be a high rate, especially if you're at like Bank of America, the bank is keeping the other, 6.5%. That's how they make money. So good for banks in that way, but it won't be good for banks if it leads to a recession where a lot fewer people want to borrow money. So,
Hmm.
um,
And
yeah,
it's hard to know which of those is pushing prices right now. What's interesting, I'm just looking at the KRE, so that's the regional banking ETF, and invert or the yield curve steepening again. I would think, oh, that's great. I look, and year to date it's down about 20%. So,
yeah,
that's not really a bright spot either.
nope. Nope, not where I would want to be. We were in that as a momentum trade for a while until we stopped out, a couple months ago. So yeah, I mean, everything's gotten hit. Valuations are too high. I mean, I think if you look at that thing, it was trading at like 2 or 3 times book value. So like banks trading at 2, 3 times book value is just stupid expensive. I don't care what the yield curve looks like. Um, so yeah, I don't know. I think, there are some unique instruments out there now where you can basically buy an ETF that goes up if the yield curve continues to steepen. I think IVOL is the symbol on one of them. It's like the curve steepener ETF, and I think there's good reason to think that continues, at least for a while. But certainly that's what's happening right now. So if that's a bet you want to make rather than just buying banks, you can just go straight up bet on the yield curve steepening. Um, that's probably not a trade we would make in any of our portfolios that we manage for, clients, but lots of people do stuff like that, and, wouldn't be a terrible idea if you thought the curve was going to continue steepening.
Hmm. And another interesting observation is if we're looking at the macro front, so we've got the tariff war going on, and then you look at the US dollar, and the US dollar's heading lower by quite a bit. And I was just reading something Wall Street Journal about the idea here is that, lower US dollar could maybe offset some tariff stuff. But then you've got like the ECB that is projected to cut rates, or I think they may have even just cut rates some more. So the one bright spot perhaps is a weak dollar does tend to help the stock market. It also helps US goods. The demand is a little higher, but now you're trying to offset that with tariffs. And I don't think you or I have the tools or the background to really make any forecasts there.
No, nobody
But
does. That's the thing. Nobody does. And anybody who thinks they do is full of crap. The global economy is way too intricate and interconnected it's not like the butterfly effect where, you can predict that. Like, imagine you could predict that how a butterfly is flapping its wings on the other side of the world was going to impact, what I have for breakfast tomorrow. It's total nonsense to think that anybody has any clue. I mean, they can speculate and they can game out, okay, here's scenario one, scenario two, scenario three, and maybe even assign probabilities to them and so on. But the idea that anybody knows with any amount of confidence that would give me nice warm fuzzy feeling about making a real bet with tens of millions of other people's dollars. Nope, not going to happen. I will just wait. I will just wait and see how it plays out. I do not need to predict the future. And like I mentioned this in my commentary too, like I don't show up to the office on Monday morning looking to, speculate on macroeconomics. That's not what people pay me to do. And to be honest, if these economists knew what was going to happen, they'd all be a lot wealthier than they are. The Fed wouldn't need 700 of them or however many these people work at the Fed, and then they just get it wrong constantly. I mean, that's one thing Donald Trump's definitely not wrong about when he's making fun of Jerome Powell for being late and wrong. The guy's wrong all the time. I mean, he said transitory the other day on inflation again. Remember that last time that happened? Inflation went from 2 to 9% and stayed there for 3 years. So yeah, I don't know. I try to stay out of the macroeconomic stuff. I mean, look, at the end of the day, our process is simple. We're looking to buy great businesses at fair prices and hold them for as close to forever as possible. And so this kind of volatility has given us great opportunities to scoop up some companies that, have been trading way above a fair price for a very long time. And so we just haven't had an opportunity to buy them. And so that's what we're focused on. It's more of a bottom up approach. But look, if you buy the best companies in the world, the ones that, you're all but certain that they're going to be doing business 10 years from now, and whether there's tariffs or not, people are going to want this thing or this brand, or like Coca-Cola, right? Tariffs. Are you serious? Like, do you think that's going to matter to Coca? You think I'm going to switch to RC Cola from Coke? No, like it's not going to happen, right? I would drink water before I drink some other cola, and I would maybe buy fewer Cokes, but it's not going away, right? And that's kind of a bad example because Coke is still trading way above its fair value, and hasn't really pulled back that much during this whole fiasco, probably because people know what I just said, is that, look, Coke's not going away. But there are companies like Hershey, that are also not ever going to go away. And, they've not due to tariffs, but due to cocoa prices over the past couple of years. That stock is trading, right around what I think is a very fair price to pay. I think under 200 I think you're okay, as long as your holding period is forever, basically. Buying Hershey under 200 that's probably a winning bet in the long run. 2 months from now, I don't know, could drop to 150. But 10 years from now, I bet you'll do okay if you buy Hershey under 200.
mm-hmm.
So I mean, not a recommendation, but that's the way we think about it, and we just do that as much as possible, and follow our stops when things begin to deteriorate. So yeah, that's what we're going to keep doing. And we just leave the emotions outside. We don't bring those into the office with us. We just come in and we execute, and we execute the process well. Process has been proven over many decades, longer than I've been around. You can back test it. You can see how it works. And I just keep doing that. And so far, so good.
That's good. And Shane, I know we're towards the end of our time here, so we can go ahead and wrap it up. But I just want to let people know the next episode, we will have that out May 15th. And Shane, as always, pleasure doing this with you. And we'll see what the market brings between now and then.
All right, Kyle. Thanks for your time, man. See you later.
Have a good one. Bye. Special thanks to our audio engineer, Stephen Crowley, for mixing this episode. This podcast expresses the views of Shane and I as the date indicated and are subject to change without notice. Elevate Capital Advisors has no duty or obligation to update information included. All information is for educational purposes only. Certain information concerning economic trends and performance is based on information from sources deemed to be reliable and has not been independently verified for accuracy. Wherever there exists potential for profit, there's also the risk of loss. This podcast may not be copied, reproduced, posted in whole or in part in any form without prior written consent from Elevate.